Welcome back. In this session we're going to talk about preparing closing entries. To get ready for the next period, we always have to prepare our books for the next period, and we do that by preparing our closing entries. And before we start talking about closing entries, we need to understand the difference in the types of accounts that we have in our chart of accounts. We have two types of accounts. One are called permanent accounts or real accounts, and then we have what's called temporary accounts or nominal accounts. Real accounts are the accounts that we see on our balance sheet. That's our assets, our liabilities, and our capital account. Our temporary or nominal account is the owner's drawing account, the revenue account, and the expense accounts. And what we want to do during the closing process is we want to take all those nominal or temporary accounts and give them a zero balance so we can record just the changes for the new period that we're going to track our income and expenses for. So we're trying to close out or zero out our temporary accounts. To report amounts for only one period, temporary accounts should have a zero balance at the beginning of the period, and at the end of the period we take the revenue and expense account balance and transfer those to a closing account called income summary. Another way to look at it would be a clearing account. The balance of the income summary, of course, is then transferred, and that the balance of the income summary will be either our net gain or net loss for the period, and we transfer that to the owner's capital account, and then we take the balance of the owner's drawing account and also transfer it to the owner's capital account. And there's basically four entries, and those entries are called our closing entries. And this chart shows the flow process or the process for doing our closing entries. The first thing we do is we zero out our revenue accounts or transfer those to our income summary. And remember, our revenue accounts have credit balances. So if we're trying to zero it out, we'll have to debit our revenue accounts and then credit the income summary. So when we look at the income summary, if we look at the credit side, that's our revenues for the period. And then we close out our expenses. Remember, expenses have a debit balance. So to close them out, we have to credit them. And so we debit the income summary and then credit each one of our expense accounts. And so the debit that we see in the income summary reflects our expenses for the period. So if we have a larger credit than we do a debit, that means we had a net profit for the period. If our debit side, however, exceeds our credit side, that means we had a loss. So the first entry, we close out our revenues. The second entry, we close out our expenses. And then we close out the income summary to the owner's capital account. So if we have a net income for the period, we'll be crediting the owner's capital account. And if we have a net loss for the period, we'd be debiting the owner's capital account. And then the fourth entry, we close out the drawing account and transfer it into the owner's capital account. And remember, the drawing account always has a debit balance, so we would be debiting the capital account and crediting the draw account to zero it out. And this slide shows the T accounts that we'd use to for the first journal entry. We would debit for net solutions. We would debit fees income for fees earned for $16,840, and then we also had a rent revenue account, and it had a $120 balance, so we would debit rent revenue for $120 and then credit the income summary for $16,960, and that represents all of our revenue for those 2 months in our fiscal year. The next thing we do, that's our first journal entry. The next thing we do is we would zero out our expense accounts, so we would debit the income summary and then credit each one of our expense accounts, as you see here. Credit wages, $4,525, rent expense, $1,600, etc., to zero out all of our expense accounts. So we have a debit of $9,855, which represents all of our expenses for the period. Now we can see that our expenses, or our debit side, is much less than the credit side, so that means we had a net income. So the next thing that we want to do is transfer this debit balance in the income summary to the capital account. So to transfer that that credit balance in the income summary to the capital account, we'd have to debit the income summary to make it equal to the credit side for $7,105, which represents our net income for the period, and credit the owner's capital account. So the owner's capital account at this point has a balance of $32,105. Started out with $25,000, had a $71.05 income for the period, so that gave it $32,105 balance. Now the only other thing we have to do is close out the drawing account, and we can see on here that the drawing account has a balance of $4,000, and it's a debit balance. So we want to debit the owner's capital account for $4,000 and credit Chris Clark Drawing, which is a temporary or nominal account, for $4,000, and that zeroes out all of our temporary or nominal accounts. And this slide just shows the how we zeroed out the revenue account and all of the expense accounts and the drawing account for the period. And this shows the actual journal entries we would make. The first journal entry, we debit the fees earned and the rent revenue and credit the income summary. The second one, we debit the income summary and credit each one of our expense accounts. The third one, we debit the income summary and credit the capital account, because Net Solutions had a net income for the period. And then the fourth journal entry, we debit the capital account and credit Chris Clark Drawing account to zero it out. And that zeroes out all of our, once we journalize this and post it, we can prepare our post-closing trial balance. But after we journalize and post those closing entries, all of our temporary accounts have a zero balance. And these series of slides just show our ledger balances, and these are our permanent accounts, so they still have balances in them. And then those permanent accounts continue over to this slide. And then we see our first nominal account, Chris Clark Drawing, and we can see that it now has a zero balance. And then on this side, we can see all of our expense accounts have a zero balance. And then they continue over to one more slide. But we can see all of our temporary accounts are now closed out. Now we're going to take a look at example exercise 4-5, and this is for Cabriolet Services Company. And this shows all of the accounts here that we need to have to do our 4 closing entries. Remember, the first closing entry we do is we zero out the revenue accounts, and for this company we only have one revenue account. It's called fees earned, and we know that's a credit balance. So to zero it out or close it, we'll have to put a debit fees earned for $380,450 and credit the income summary, $380,450. The next thing we'll do is we'll debit the income summary for $339,450, which represents a total of all of our expense accounts as shown here. Wages expense $250,000, rent expense $65,000, supplies expense $18,250, and miscellaneous expense $6,200. And you total that up, and that comes out to the $339,000. So from these two entries, we can see that our income summary has a credit balance in it. At this point, we take the $380,450 and subtract the $339,450, and we come up with a $41,000 credit balance. So to zero out the net, to close out or zero out the income summary account, we need to debit the income summary, $41,000, and credit Terry Lambert capital $41,000. And then the only other thing we need to do is close out the capital account, and so we debit Terry Lambert Capital for $25,000 and credit Terry Lambert Drawing for $25,000. And we will stop at this point and then pick back up in our next session. Thank you.